Over in the United States, all eyes are once again on the Federal Reserve after a decision that many people had been waiting for but were still watching closely with a mix of anticipation and uncertainty. For the first time this year, the Fed has officially cut its key interest rate, a move that was widely expected but still significant in its timing and in its implications for the broader economy. The central bank didn't just stop there either, because alongside this decision, it also signaled that more rate cuts are likely on the way, projecting as many as 2 more by the end of the year. This comes at a time when concerns about the U.S. labor market are growing and when the question of how to stimulate growth without reigniting inflation is more pressing than ever. For months, the Fed had been keeping rates steady, carefully weighing the effects of inflation and keeping one eye firmly fixed on the ripple impacts of President Trump's tariff policies. But now, with jobs data slowing and revisions to employment figures showing that the labor market isn't as strong as it appeared just a few months ago, the Fed's hand has been forced. This was not an easy decision, but it was a decision that many economists, investors, and business leaders expected, and it immediately sparked strong reactions across the financial markets. Stocks rallied ahead of the meeting in anticipation. Investors cheered the quarter point cut when it came through, and yet questions remain about whether this is a temporary measure or the beginning of a larger policy shift designed to provide relief for borrowers, businesses, and consumers alike. Despite the fact that the Fed operates independently, it has been impossible to ignore the considerable pressure that President Trump has been placing on the institution, and specifically on Chair Jerome Powell. For months, Trump has been publicly calling on Powell and the Federal Open Market Committee to lower interest rates, claiming that doing so would provide the U.S. economy with the shot in the arm it needs to withstand both international headwinds and the self-imposed strain of ongoing trade disputes. Trump has not held back in his criticism of Powell, often mocking him for moving too slowly, suggesting that the chair has been behind the curve and even threatening to replace him altogether. That threat looms in the background of every Fed meeting and every Powell press conference, and while Powell himself has consistently insisted that the central bank's policy is apolitical, independent, and driven solely by data, there is no denying that political pressure is a constant factor in the background. What makes this moment interesting is that in the end, the decision to cut rates this week was not driven by Trump's demands, but rather by the Fed's own assessment of where the economy stands and where it is heading. And what they see when they look at the numbers is an economy that is slowing down and a labor market that is showing cracks in its previously robust surface. Ally Kelly, a reporter with Business Insider who has been following these developments closely, summed up the decision as one that largely met market expectations. Investors had already priced in a quarter-point cut, and the momentum in U.S. equities reflected that. In her view, the importance of this move lies in how it signals that the Fed is now shifting from the restrictive stance it maintained earlier in the year to one that is more supportive of growth. For much of this year, Powell and the Fed governors had been careful, maintaining higher rates to balance their dual mandate of keeping prices stable and ensuring a healthy labor market. But as new jobs data rolled in and showed far fewer jobs being added than initially reported, it became clear that the employment picture was not as strong as it had seemed. The revisions to the data weren't just minor adjustments. They revealed a real and growing weakness in the labor market that forced the Fed to act. And while inflation has been relatively contained, the risk of stagnation or even a broader economic slowdown has been rising. When the Fed sees that kind of imbalance, sluggish job creation, weaker consumer confidence, and businesses holding back on investment, it becomes hard not to take action. Cutting interest rates is one of the most direct tools they have to try to stimulate growth, encourage borrowing, and give businesses and households a bit of relief. That's what this rate cut was about, and the fact that there was broad agreement among Fed governors suggests that the urgency of the situation was widely recognized within the central bank. Interestingly, while in the Fed's previous July meeting there had been dissent from 2 governors who voted against a rate cut This time, the consensus was much stronger. Most of the governors voted in favor of the quarter-point cut, and one even pushed for a larger reduction. That level of agreement shows that the Fed is now more aligned in its view that policy needs to be adjusted to prevent a deeper slowdown. Powell's job isn't an easy one, and he's made it clear that his focus remains squarely on data, not politics. In his remarks following the decision, he doubled down on the Fed's independence, reminding the public and the markets that for decades the institution has operated apolitically, and it intends to continue doing so. This is a critical point because in the eyes of the Fed, maintaining credibility depends on being seen as objective, transparent, and committed to long-term stability rather than short-term political wins. That said, Trump's pressure isn't going away, and with an election season heating up, it's likely to intensify. Trump has already made it clear that he wants rates even lower, and he views cheaper borrowing as key to sustaining growth and keeping markets buoyant heading into the election cycle. The Fed, meanwhile, is trying to walk the tightrope of responding to economic signals without appearing to cave to political demands. This delicate balance will likely define Powell's tenure in the months to come. It's worth noting that Powell is expected to remain in his seat until May 2026, meaning that unless Trump were to take the dramatic and controversial step of trying to remove him, Powell's leadership is secure. That gives him some breathing room, but it doesn't shield him from the criticism or the constant public commentary that comes from the White House. What will matter most is whether the policies that Powell and his team put forward succeed in stabilizing the economy, supporting the labor market, and keeping inflation under control. If they do, Powell's independence will be vindicated. If not, the pressure to align more closely with political demands will only grow. For average Americans, the Fed's decision has practical implications that go beyond the headlines. Lower interest rates can mean cheaper mortgages, lower credit card rates, and more affordable borrowing for small businesses. At the same time, savers may see lower returns on their deposits, and there is always the risk that too much stimulus could eventually lead to inflationary pressures. That's the balancing act the Fed is trying to manage. They want to support growth without creating new bubbles, and they want to ease pressure on borrowers without undermining the long-term stability of the financial system. This is why every rate cut is scrutinized so heavily, not just in the US, but around the world. Global markets look to the Fed as a signal of where monetary policy is headed, and decisions in Washington ripple across Europe, Asia, and beyond. Investors abroad take their cues from the Fed, and other central banks often follow suit. The fact that the Fed has now signaled potentially 2 more cuts this year sends a clear message: the US economy is slowing, and the world's most powerful central bank is prepared to act decisively to counter that slowdown. Whether those actions will be enough remains to be seen, but what is certain is that Powell and his team are stepping into a more active, interventionist role at a time when uncertainty is high. So, as we look ahead, the questions are clear. Will these cuts be enough to sustain the labor market? Will inflation remain contained, or will it creep back up as borrowing increases? And perhaps most importantly, will the Fed be able to maintain its independence in the face of unprecedented political pressure? Only time will tell, but for now the signal is clear. The Fed is moving, the economy is slowing, and the path forward is one that will require careful navigation and constant adjustment. That's the reality facing Powell, Trump, the markets, and ultimately every American household that feels the impact of these decisions in their daily financial lives.